Hi everyone, my name's David Peters and I am from Peters Professional Education. Welcome to our course today, A History of Investing and a Look Ahead. Investing theory has changed a lot over time. We don't necessarily think about that when we're putting together portfolios nowadays. There's certain concepts that I think we kind of take for granted. Ideas like diversification, ideas like risk matters in the portfolio, ideas that assets have certain characteristics and that make them unique, and that if I put them together in certain ways that unique things happen. Those ideas, I think, are things that we take for granted. And the fact is that it didn't always used to be that way. We haven't always looked at investing in the comprehensive way that we do when we're building portfolios today. This course is really about looking back throughout history and trying to figure out where we've been. How has our thinking really evolved when it comes to building a portfolio? It's not that we're going to today learn about the next sort of get-rich-quick scheme. That's not really what's going to happen today. That shouldn't be an expectation that is coming away out of this course. Really what we're going to do is we're going to try to get an understanding of what exactly do we mean by some of the concepts? How has some of our thinking changed about ideas like diversification and portfolio building so that we can better understand what these terms mean so that we can build better portfolios for clients? That's really what today is all about. Serving our clients better understanding kind of how to build a portfolio and how the thinking has changed about portfolio building over time. Let's take a look at what's ahead here. So we have three big learning objectives in today's course. The first one is we're going to identify the contributions of Harry Markowitz to modern portfolio theory. So modern portfolio theory is this idea that there's a trade-off between risk and return. And before Harry Markowitz, we really didn't think about portfolio building in that way. And so Harry Markowitz, very key person when it comes to portfolio building and investing. A lot of our ideas center around the thoughts that Harry Markowitz came up with. And so we'll talk about his contributions and how his contributions have been expanded upon by others as we move forward through time. We're going to recognize how the concept of diversification has changed over time too. Diversification in and of itself is a very easy concept to understand. I mean, it's really this idea that we shouldn't put all of our eggs in one basket. That's sort of the way that my grandmother would probably define diversification is don't put all your eggs in one basket. Certainly, it's an easy concept at a high level, but what exactly constitutes diversification, that idea has changed over time, and so we're going to be talking about that as well. We're also going to distinguish between the major factor investing models. We'll talk about what exactly factor investing is, and if I wanted to screen for specific factors in a portfolio, what exactly would I be looking for? What would I do to engage in that process, and how would that help me build a portfolio? That's what we'll be talking about today as well. We'll also talk about how those ideas have sort of translated into ideas like smart beta and things like that. So the place that we got to start is the Great Depression. So we started the Great Depression because that was really before a lot of our more modern understandings of portfolio building really came about. During the Great Depression, really the idea is to find undervalued investments. And what we meant by that was more what investments do we think that people are going to want. So what companies, what ideas, what products are people going to be buying? And so there was really sort of this fundamental idea that we needed to find those products, those investments, those companies that people were going to want. So very simple supply and demand. And that's all fine and good, and certainly that continues to help shape the way that we look at investing today. That's a part of it. But the game really changed in 1938 with a paper by John Burr Williams. So John Burr Williams was kind of the first pivot point in investing history, because what he said he said that companies have a fundamental value. There's an inherent value, there's an intrinsic value that a company has. It's not just about supply and demand. The fact is that certain companies are better than other companies by their fundamental characteristics. And so John Burr Williams was the first one to kind of add this additional concept to supply and demand. So when we're looking at investing, it's not just about what do people want, it goes deeper than that. It's what companies are built better than other companies. And he was really the first one that came up with this idea of the dividend discount model. And we're going to be talking more about that here in just a minute. After Williams, after we've kind of developed this idea of the dividend discount model, we started to see sort of more systematic approaches to investing, and we started to see modeling start to come about. And that really fed into the ideas of Harry Markowitz, which came about in 1952. And we're going to be expanding more about Markowitz here in a minute, but Markowitz's sort of fundamental idea was that there was a trade-off between risk and return. And so we kind of take that idea for granted now. However, back in 1952, when Markowitz was first getting started and he comes out with this paper, blew everybody away because they'd never really thought about investing in terms of risk. I mean, it was really just about, how can I find sort of undervalued investments? And so Markowitz kind of changed the game in that way. So let's talk about these first two pioneers in portfolio building. So we got to start off with John Burr Williams. Like I said, John Burr Williams really changed the game. 1938 came out with a paper called The Theory of Investment Value. And what he said in that paper is that investing is more than just guessing consumer expectations in the market. It wasn't just supply and demand. Certainly that's a part of portfolio building. We're trying to figure out where is the demand going to be? But it goes beyond that. There's certain concepts, certain ideas, certain ways of building a company that are just inherently better than others. And companies have a real value that's associated with them. And what we have commonly referred to that as is an intrinsic value. So companies have intrinsic value. Some companies are built better than other companies. That was the whole idea. So even if a product was sort of wanted more by society, the fact is that if the company wasn't built well, that still would probably not be a good investment. And John Burr Williams was kind of the first one to come up with that idea. Very simple concept, I think, for our modern ears. But back in the 1930s, blew everybody away. The intrinsic value of a stock is composed of discounted future cash flows. So this is another unique concept that Williams kind of brought to the forefront. Basically what he said is that a company's not really worth anything unless an investment in it results in cash. And specifically, it's not about the cash that the company has, it's about the cash that the company is going to generate in the future. So really, the way that we can look at sort of an intrinsic value of a company is by discounting future cash flows. So basically, we look at what are the cash flows of the company after we become an investor. So we don't really care about the cash flows that are in the past because we're not going to participate in those cash flows, but the cash flows that the company is going to give out to us in the future, probably in the form of dividends. So dividends in the future, that is what we care about. And if we were to sort of take all of those dividends and if we were to extend them out really until the end of time, and we were to sort of discount those back because future dividends are worth less than dividends that I have in my hand now, right? So if I have a dividend that I'm going to get in 6 months, that's more certain than a dividend that I'm going to get in a year or 2 years or 3 years. So in other words, applying a discount factor that makes it so that dividends that are further out in the future are worth less than dividends that are closer to us in time, that is going to ultimately result in a company's intrinsic value. That is the fundamental worth of a company. Very unique ideas and really kind of the first sort of inklings of modeling and sort of quantitative modeling when it comes to investments. And so discounted cash flow methods were really kind of the way that was introduced by John Burr Williams. These days we see discounted cash flows all the time, but my goodness, before Williams, no such thing. What this translated to, this idea that a company's intrinsic value was really based off of the discounted future cash flows of that company. What that turns into is that if you were to sort of take that and sort of extend that model out, ultimately, those cash flows that are really far out in the future, they approximate zero. And so what you can do is you can simplify that model that Williams put forth, and you can simplify it into what we call the Gordon growth model today. It's also called the dividend discount model. You'll typically hear me refer to it as the Gordon growth model, and here it is up on the slide here. So the Gordon growth model is a simplification of the ideas put forth by Williams, that the intrinsic value of a company is its discounted future cash flows. If I were to simplify that, what I come up with is that the cash flow at time one, okay, so not the cash flow that just happened, but the cash flow that is going to be sort of one step in the future, cash flow at time one, future cash flows is in the numerator. If I divide that by the required rate of return, in other words, what it would take to keep me as an investor interested in that particular company, what sort of rate of return is required to keep me interested in the company, minus the expected growth rate of the company. So in other words, we expect that as the company grows, that dividends are also going to grow. Cash flows are also going to grow. And so that's sort of the simplification of the ideas that were put forth by Williams, that a company is worth its discounted future